Good day, everyone. My name is Rebecca Lilly for the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Export Growth, Fuel Price Nexus in Developing Countries, Real or False Concern. We are grateful to Roland Kpodar for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services that you can find at our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our speaker, please click the Q&A button at the bottom of the Zoom window and type your question. We've allocated time at the end of the webinar to read and answer them. And now, I would like to introduce you to Roland Kpodar. Roland is Deputy Unit Chief in the Strategy, Policy and Review Department at the International Monetary Fund and Senior Fellow at the Foundation for Studies and Research on International Development. Roland, over to you.
Thank you, Rebecca, for the kind introduction. It's good morning, everyone. It's a privilege to be here today and have the opportunity to talk to you. I will also like to thank David Williams for the invitation to this seminar. Today, our discussions will be around the nexus between changing domestic fuel prices and and countries' export performance. So for the webinar to be interactive, feel free to ask questions in the chat box as the presentations progress, and I will be happy to take the questions and then and address them. So without further ado, let me share my screen, and hopefully you will see the presentation. Okay. Okay, is it visible to everyone, the presentation? Rebecca,
Perfect.
can you just confirm?
That's perfect.
Okay, excellent. Thank you. So this presentation draw on a paper published in the Energy Journal in this year, volume 43, issues number 3. And the paper was co-authored with 2 of my colleagues, Stefania Fabrizio and Kojovi Eklo. Let me just give you a little bit of background why we choose to focus on this particular topic. The fund has done a lot of work on the issue of fuel subsidies, mostly because a lot of our member countries come to us and asking policy advice on how they can tackle fuel subsidies. And from there, like it's from the early 2000s, we have started this new area where we are much more interested in the distributional aspect of policy, notably the pricing of fuel products. It's well known that energy subsidies worldwide are large. The latest estimates, it was in 2020, puts the figures around 5.9 trillion, which is about 7% of GDP. And back then, the projections was that this share will, the size of the fuel subsidies will increase to up to 7.4% in 2025. Obviously, nobody could predict back then that the COVID pandemic would be there, then followed by the war in Ukraine. Maybe before even I go to the detail, let me just flag, the book I have on the right hand side of the PowerPoint, which is, it has been published by the IMF in 2023. It collects it summarized the thinking behind IMF policy advice in the area of energy subsidies reform. And it's interesting in the sense that it has the theoretical part, it also has the different country cases where you can see you can have a good sense of in practice how this reform are implemented, why some of them were successful, why some of them failed, and what are the lessons for other countries seeking to embark in this in this reform. So if you recall, early in the pandemic, crude oil prices fall to about $10 in March 2020, and then gradually recover and reach $80 a barrel in October 2021 as the post-COVID recovery takes hold. But then with the war in Ukraine in March 2022, crude oil price reached $120 a barrel, which now has receded a little bit, but still around $85 to $90 a barrel. And this has been a stark reminder to policymakers that fuel subsidies will not go away, and the prospect to see the prospects to see oil prices going down in the near future are very slim. Again, the pitfall of these fuel subsidies are well documented. They are fiscally costly, they are bad for the environment, and they are unequally distributed. Yet, they continue to be prevalent in many countries due to the difficulty to reform them. Many countries still, particularly in the developing world, still have a tight control on the pricing of fuel products at the pump. Unfortunately, the windows of opportunity for reform has just closed. It's also well known that when oil prices are low, it creates a window of opportunity to implement this difficult reform because it's easier to increase domestic prices when international prices are low rather than the opposite. Now, with the barrel at 120, at about $90 and with the price of crude oil at around $90 a barrel, it's become difficult to undertake this such reform. Yet, challenges are still there, and policymakers will have to face them and address these issues, especially in the current context of the debate about climate change and what countries can do to achieve the NDCs and to achieve the and globally that to achieve the climate the climate target. So against this background, policymakers, what's hold them to reform fuel prices? There are various concerns, and chief of them is the impact on the poor. But there are also many countries which are concerned about the impact on competitiveness, and this is what we are looking at in this paper. So it's interesting to later I'll get back on why particularly the export sectors. It's just one part of the economy, but I'll tell you why we focus on that. So the research questions we try to address in this paper are the following. Does an increase in domestic fuel prices undermine a country's external competitiveness, which we measure by export performance? Then the next question is to ask, what are the potential conditioning factors? Is the average independent on the country characteristics, or there are some factors that are also at play? And here we focus on two of them: energy dependency or access to other energy sources And here in this paper, we looked at access to electricity. It's also important to investigate whether these effects are more temporary or medium or more structural and or are long lasting in the medium and long term. It's important because it will affect the design of the mitigating measures of how policymakers should respond to or should design this type of report. So in this presentation, I will structure the discussions around three main points. First, I'll go through a brief preview of the literature to give you a sense of what is already out there, how we position this paper relative to the current literature. Then I'll discuss the empirical part, the data we have used, the model, the econometric model, and also give you also some descriptive analysis. Then finally, I'll move to the main result, and then the conclusion and policy implications. So let me recap the finding upfront before I go into the detail. We use a sample of 77 developing countries with data over the period 20 to 2024. We use three different econometric approaches, the fixed effect estimators. We also use the system GMM, and then we complement the analysis with the local projection developed by Jordan in this famous article in 2005. So quickly, the main result, unsurprisingly, we find that idiosyncratic shocks to domestic fuel prices adversely affect the export sector. However, the impact is much larger than what we initially thought. We thought that the impact could be modest, but you'll see in the result that it's really big. But this average effect, what is important to note is that this average effect actually hides a lot of heterogeneities. The impact is larger in countries where there is a high energy dependency ratio and where access to alternative source of energy is limited. Also, fortunately, the impact is only confined in the short term, like in within 1 or 2 years after the shock. I would like to emphasize that in this paper, we are looking at an idiosyncratic shock to domestic fuel prices, and I'll come back to explain why it's important to look at the shocks, like a specific shock to the country, and not have other countries experiencing the same shocks simultaneously, because then the identification is much more complex on that front. So let me delve into the transmission mechanism. And I'm sure that you are aware of this and you are familiar with it, but for just to be comprehensive, let me go through them one by one, and then I can I'm happy to go back if something is not clear. So, like similar to household, you have energy prices affect firms through two channels. So you have the direct effect, and the direct effect is associated with the consumption of energy products in the production process of the final good, the good of the product sold by this particular firm or sector. So it's a direct impact, and that's it's instantaneous because it affects directly the production cost. So that's the direct effect. It's similar to household consuming fuel products for the car, for heating and so on. But then you also have the indirect impact. The indirect impact is goes through the actually it's related to the energy inputs that goes into the intermediate input used in the production of this sector. So one example is the transport cost. So transport cost is sensitive to fuel prices. It will add to the price of the final price of the goods and services that need to be transported from the firm to the market. And that this channel is indirect because it has to feed through the supply chain, and it can take a little bit of time depending on how the market power of different actors. It can take a little bit of time before being reflected in the price of the goods, final goods and services of the export sector. And the degree of this, the direct and the indirect impact, the magnitude depend on the energy content going directly to the production of the goods, but also indirectly through the production or the intermediate input. The second point I wanted to mention is that the ultimate impact of an increasing domestic fuel prices on the prices or on the export sectors depend on the reaction of the firms. How firms in this sector react to the energy price increase. And in a nice paper, Renshled and his co-authors try to, summarize or put a nice structure on these different type of responses, and they distinguish between 4 of them: absorption, substitution, resource efficiency, and pass on. I'll go through them one by one and then to explain. First, absorptions occur when, for example, margins are high and the firm could afford reducing its profit to absorb the increase in energy prices. Firms can also opt for cutting back investment to make space for the high cost of energy. The second type of response is substitution. If there are alternative sources of energy which are more cost effective, firms would be tempted to substitute energy, let's say fuel, to another source of energy. Could be LPG, could be electricity, and could be another product. However, this substitution doesn't happen in the short term because it may require a change in technology and also access to credit, which the company may not afford. The third type of response is resource efficiency. Is when firms try to, with the same technology, trying to improve resource efficiency, how we can decrease the energy consumptions per output. Here again, this could involve updating the production process or the technologies, which may not be straightforward for those firms. And the last type of response is fully pass through the increase in energy costs to the final consumer. And let me just now this is the general framework. Let me tell you how this applies to the export sector in developing countries. Typically, this export sector in developing countries is dominated by small and medium enterprises They are more intensive in labor than capital, and they are price taker on the world market. So passing the cost of higher energy the cost of higher energy uh, 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 like the high cost of energy to the final consumer is not an option for them because they could lose their market share. They have a price taker. They have very competitive firms in other countries. So the pass on the last strategy we have here is really not an option for them. For substitutionary resource efficiency, it's more a medium, as I pointed out, it's more a medium-term responses. So they may not even have access to credit or the technology to substitute the energy product or to improve the resource efficiency. It's also possible that they they don't have the access to financing to do that, or they sorry, so the substitutional resource efficiency, or maybe they don't even have the technology, the technology to do that. And I wanted to mention also one point on the resource efficiency. It's the availability. One point on the substitution is the availability of alternative source of energy. They may not be available for them. So the only option left is the absorption. So the absorption, the problem with it is that in this sector, typically the margin are thin, and which makes them vulnerable to external shocks. And in these countries, the export sector bring a lot of foreign exchanges. They are also, as I pointed out, they are also labor intensive. So they create a lot of jobs, which makes policy makers worried about how an increase in domestic fuel prices will affect those companies and the ripple effect to the rest of the economy. I would also like to mention like two points on how the ultimate impact of the increase in domestic fuel prices on the export sector will depend on macroeconomic policies, the response to the price increase, but also the improved resource allocation. Typically, an increase in domestic fuel prices leads or translates to an increase in inflation in the country. And the credibility of monetary policy is crucial here. If in a flexible exchange rate regime, if the monetary policy authority is credible, the impact on inflation will be limited because they will be able to tighten monetary policy and limit the impact on inflation. The fact that monetary policy authorities can contain inflation will help on the appreciation or the magnitude of the appreciation of the real effective exchange rate. That is crucial for the competitiveness of the export sector. Note that also when domestic fuel price increase, it translates to better fiscal accounts because the government will not be forced to subsidize the fuel prices, and the increased confidence from sustainable fiscal policy will stimulate productivity, but also the private investment, which will help, which will contribute to the production, to the private sector to invest more and being able to to export. Second point I wanted to mention is on the price distortion. Fuel subsidies typically lead to price distortion in the economy. So it distorts the signal to the private investor. And by reducing these subsidies, this improve resource allocations, enhance the productivity factors, and which could help on the competitiveness of the export sector. And this has been extensively discussed in the paper of Sanders and Schneider in published in 2000. So now, I hope it's okay if anybody has a question, feel free to stop me. There's now, let me take a stock of the literature here. I would like to talk about two spans of the literature, the theoretical literature, but also go to the empirical literature. If you look at the traditional theory, the trade theories, the theory of comparative advantage and the new trade theories, they do not explicitly model fuel prices or energy prices. The theory of the traditional trade theory posits that countries will export products where in which they have comparative advantage, or the either in the production cost, or they have or the endowment factors allow them to be more competitive. And this is the prediction of the Ricardo model, but also the externally model. So, but obviously, this fuel price or energy prices has a role there, but this was not explicit. If you want to look at papers where energy costs or energy prices are explicitly modeled in the theoretical theoretical trade framework, then I will refer you to a nice paper by Chan and co-authors, where they use a Malin-style model to estimate the impact of an increase in carbon taxes on export in the European Union. And they found that a carbon tax that sorry, unilaterally increase energy price by 10% could reduce net manufacturing export by 1.9% annually. Another interesting paper that incorporates energy prices in a trade model is Bridgman in 2008. But the difference with Chan and others is that the modeling is about the transportation cost channel. So it's more the indirect channel I discussed earlier than the direct channel, which is the focus of the paper of Chan and others. And Bridgman found that oil price shocks raise transportation costs, which offsets the positive impact of tariff reduction on international trade during the period 74-85. There are also a parallel literature on the pollution haven hypothesis. A couple of these studies found that climate mitigation policies also affect the competitiveness of energy-intensive industries. And this energy-intensive industry will tend to move to countries where where energy pricing policy, where the energy pricing policy is less climate friendly. So, and now this is just like quick summary of the theoretical literature. And I wanted to talk about the empirical literature, where is the contribution of this paper. So you have Renchel and Corning in the paper in 2017. They found that for energy firms, for firms in Indonesia, energy prices have a small and statistically significant and negative impact on long-run competitiveness. And this result is consistent with what Orion found for Chile, Clement, and others for Indonesia again, and Lee for China, but also Soleimani and Kari for Malaysia. But the results in the empirical literature are mixed because you have another set of studies that found a small positive impact depending on the ability of the firms to adapt. So, for example, Hope and Sins in 1995, but also Clement and others, they found that in the short term, you have a negative impact. But because of the improved fiscal position and the confidence effect on private investment, this negative impact in the short term will turn positive in the medium to long run. So how we position our paper in this literature? Why these studies I tried to summarize in the previous slide have contributed significantly in better understanding the nexus between change in domestic fuel prices and exports. Most of the studies focus largely on advanced economies. And this is rooted in the long-standing debate on the level of energy prices in Europe versus in the US, where many scholars argue that because in the US, energy prices are cheaper than relative to Europe, they provide a competitive advantage for US firms over European firms. So the literature have extensively studied these issues. Yet, fuel subsidies are prevalent, much more significant, and it's more, let's say, as more bearing on macroeconomic stability in developing countries, but the literature is sparse on that front. The few papers that focus on developing countries, they are either country specific, so looking at one country at a time, which makes it difficult to draw broad policy conclusions because countries are different from each other, and also they use firm level data, which means the point of how macroeconomic aggregates can affect overall competitiveness. And one important point I wanted to mention here is that, which is critical for subsidy reform, it's when you look at the data or the impact at the firm level, it doesn't give you a sense of what is happening in the overall economy, because you can have some firm which will suffer from the increase in domestic fuel prices, but you have other firms which will do better, and in aggregate, the aggregate impact on the economy could be positive. So if you only focus on the firms that are adversely affected by the increase in domestic fuel prices, you miss the point, because it's very difficult to make a case for the subsidy reform. But if on aggregate, you can see how the impacts offset each other depending on the heterogeneity of the firm. There could be a case for a reform while appropriate mitigating measures could be designed to compensate the firms that will be losing from this reform. And this is what our paper is trying to do. Look at overall, from the macroeconomic standpoint, how countries are affected by changing domestic fuel prices. Let me now move it to umbilical parts. So the data we have 75 developing countries. We have data covering the period 20 to 2013, and the sample is limited by the availability of data on domestic fuel prices. The period of study also is constrained by this by the fuel price data. So we use a fixed effect estimator and the local projections, and I'll explain why the difference between the two approaches and what type of questions we're trying to address. Then on the energy products, we consider we use gasoline and diesel. So the main results are focused on gasoline prices, but we also put in the annex of the paper, we run the same specification for diesel prices, and the results are consistent. Okay. I hope I'm not missing any questions. I still have the chat here, but feel free if you have any question to stop me. So now let's look at the baseline model. What is the specification we have adopted? We look at the literature and see, what other studies have done when they try to explain identify the determinant of export. And we're trying to put like what are the common determinants that we see in a wide range of studies, and we focus our interest, our paper on this. So we on the left hand side you have the change in export. Sorry, but here it's important that we're looking at the real non-fuel exports of the country. So we want to take out the price effect, to look at the quantity, how fuel prices affect the quantity. But also it's obvious that we shouldn't exclude the fuel sectors because we are interested in non-fuel products. And we try to explain the change in export by the lagged value. It's important here because there is a lag effect. But from the time fuel price are increased to the time you see the impact on export, it can take some time. So we have up to 3 lag in the model, and the length of the lag was selected based on the AIC information criteria. And in addition to that, so the change in fuel prices is our variable of interest, and we have some control variable, among which we have the real effective exchange rate, which is an indicator of the competitiveness or how competitive the export sector is. So we expect a negative impact on export following an appreciation of the real effective exchange rate. We also include an indicator of product diversification. A diversified export base help countries to better absorb shocks, which means that exports which could stimulate export because they're not just exposed to one single sector, but they are competitive in a wide range of export products. We also have the ratio of foreign direct investment to GDP. Just to capture the transfer of technology, we expect that a higher ratio of foreign direct investment to GDP will imply that the countries is more competitive, can attract foreign investor, which could help the country export much more than otherwise. We include the inflation rate. The inflation rate, it's also correlated to the real effective exchange rate, but we just wanted to separate to isolate the impact of the inflation rate. We also use an indicator of external demand, very important. The exports depend on global demand, and in here to have some some cross-country differences in the external demand. We use the average GDP growth rate of the world, excluding the country we are focusing on. So, which give us some variation across country instead of just using like the overall world real GDP growth rate. So now, a couple of descriptive statistics. Just look at the sample distribution of fuel prices. As you can see in the chart, the top channel, look at the diesel and gasoline prices. We see that the distribution is skewed to the right, so you have more positive changes in domestic fuel prices than negative changes. And the negative changes are more concentrated during the drop in crude oil prices, the significant drop in the second half in 2022. And this is an illustration of the rocket and feather effect, which has been extensively studied in the literature, whereby fuel prices, domestic fuel prices, tend to increase most of the time than decrease. And here you also see that there is a bunch of countries at the zero here, so that it tells you this. It tells you it reflects the fact that in many developing countries, the fuel prices are tightly controlled by country authorities, and sometimes they may not change for a year or even 2 years, and you'll see huge bumps. So, it's really telling this chart how the distributions is the distribution of fuel prices. And if you look at advanced economies, you will see a different distribution. So then the bottom channels, it's a two-way chart between diesel and gasoline prices and real non-fuel export growth. There is a slight negative impact in relationship, but the next slide will show more what is happening here. So what we did is that we separate the sample in two different subsamples. One sample is for countries below median energy dependency and above median energy dependency. Energy dependency is measured by the energy consumptions per capita expressed in kilogram of equivalent oil to the population of the country. And interestingly, if you look at the sample of countries below the median of median energy dependency, the relationship or the correlation between fuel price changes and real non-fuel export growth is almost flat. You don't see a negative impact. While this negative impact is much more pronounced in countries where, in the sample of countries above the median energy dependency. We see also the same thing using diesel prices. Let me now, we have 15 minutes left. Let me now go through quickly the results. So this table actually shows the estimations by the fixed effect estimations. And as you can see in the change in gasoline pump prices has a negative and significant impact on export. And the magnitude or the marginal effects tend to decline as we increase the lag of fuel prices, which means that the impacts tend to phase out over time. Here, if we just interpret this result, we said a 1% increase in gasoline prices could lead to a 0.5% decline in export, which is quite huge. We were surprised by the magnitude of the impact, but it's also reflects it's also suggests that the concern from policymakers, the concern on the impact on fuel subsidy reform on the export sectors may be substantiated. So this large impact was it's quite stunning, and we look at the conditioning factor in the next slide. So if we look at the control variables, we have predictably we have the log of real equilibrium exchange rate, which has a negative impact on export. So exchange rate appreciations undermine country export, diversifications boosts export as expected. Inflation is contributing negatively to export capacity. We in the second column, we add the external demand, which is turned out to be strongly significant and positive. So which is consistent with what we expect. More external demand drive export. We in the third column here, we add the lag value of real non-oil real export, just to capture the dynamic, because with this convergence in not it's akin to the convergence income convergence hypothesis, where exports tend to grow faster when the initial level is low. So because we introduced this lag value, we've run a system GMM which address the presence of the lag dependent variable, but also control for it's an attempt to control for the endogeneity, and we see similar result than in the previous specification, although we lose significance of the real effective exchange rate and others. Surprisingly, we did not see any significant impact from FDI, maybe in just in column 4, and it could be that yet maybe they are not quite sizable for developing countries, and there are also studies that show that much of this FDI reinvested earnings. So they are not new of fresh flow of money, which will explain why we don't see any significant impact. So now we did a couple of, I'm watching the time here, we did a couple of like other specifications. So we used diesel prices, we found consistent results. We also tested the impact of a large domestic fuel prices versus small change in domestic fuel prices. And this is the long-standing debate between the proponents of the shock therapy in fuel subsidy reform and the proponent of gradual approach. The proponents of the gradual approach are that it's better to increase gradually fuel prices to reform fuel subsidy, because it gives time to households and to the productive sector to adjust to higher prices. But there is the other side of the story where you have the proponent of the shock therapy approach. They add that no, because there could be some resistance to this reform, it's better to have to increase the prices in one go instead of going instead of adopting a stepwise approach. So we try to see if we introduce this square of domestic fuel prices, if this will be significant or not, or if we separate the sample between small change in domestic fuel prices and large change, do we see big differences? We didn't see anything. We don't have empirical evidence that the shock therapy approach or the gradual approach is superior to the other. So we also tested the heterogeneity between countries with low versus high fuel subsidies. We tested the heterogeneity across regions, Sub-Saharan Africa, Latin America, Asia and Pacific, and we also tested the heterogeneity across selected export groups. In a nutshell, we found that the adverse impact of fuel price increase on export is much more pronounced in Sub-Saharan Africa than in Latin America. In terms of for selected categories of export, the impact is much larger for food export, probably reflecting the sensitivity of food price to transportation costs. And the second categories of export goods, the most sensitive to the domestic energy fuel prices is the manufacturing, followed by agricultural export. So now here in this paper, we're trying to look at the conditioning factors, and we, as I mentioned earlier, we have two: energy dependency and also access to electricity. And we found that the impact is much higher in countries with high energy dependency, as we see the coefficient in negative, which means that high energy dependency magnifies the negative impact of higher fuel prices on export. We don't find very strong result for the access to alternative source of energy, such as electricity. However, that's for gasoline, but however, for diesel, we have the significant result. Now, we look at the fixed effects model does not allow us to distinguish between the short term and the medium term. So we need to move to a more dynamic framework to capture how this impact could vary in the short versus medium term. For that, we have to make changes to the baseline model and use the local projection approach, which differ from the fixed effect in two aspects. The dependent variable is not only the contemporaneous value of export growth, but also the future realizations at different horizons. The local projection also require to include the correction factor, which is here, which is the third term of the equation. This correction factor was suggested by Turing and Zubanov to capture changes in fuel prices observed within the forecast horizon. So this is the impulse response function. And here we just go straight and separate the samples into two. We have the sample of countries below the energy dependency, the average value or the median, and we also have the countries, the sample of countries above this value. If you, as you can see here, we don't have a significant impact on for countries where the I mean, the level of energy dependency is below the average value. But once you see the second sample, you see that the impact is drastic, it's negative in the short term, but then tend to phase out and become non-significant from the second and third year. And this is also the we do the same for the access to electricity. We see the negative impact for the sample of countries below the average value. And let me just clarify, the access to electricity is the percentage of urban households having access to electricity. Unfortunately, we don't have I mean, for the productive sectors, but we think that it's a good proxy. And when we look at the sample of countries where access to electricity is above the average value, the impact in the short term is not significant. It's but with the the first year after the shock, we see some impact, but then this disappears in the second and third year. Okay, now let me go through the conclusion and the policy application. Still no question until now. Maybe I'm clear in the presentation, but very happy if you can stop me and ask questions. We will have a few minutes there if you guys want to intervene. So let me recap the result. Fuel prices increase leads to a non-negligible decline in real non-fuel export growth. Is there? So the concern from policymakers is valid. So how do we? But still, this is not enough, or this should not be. This is not sufficient, or say, this should not prevent from reforming fuel subsidies, because you have other effects of those subsidies on the economy. It's important to highlight that the impact is much more pronounced in countries where there is a high energy dependency and low access to electricity, even though the empirical evidence is less strong on the latter. But it gives a sense of what are the policy tools or the mechanism through which these domestic fuel price negatively affect export, and how countries can leverage this mechanism to mitigate the impact of the export sector. So we also find that the impact is in the short term, up to within the first 2 years after the shock. However, the export level, because we're looking at the change in export level can be permanently lower if the benefits from reduced price distortions or better allocation of resources stemming from the subsidy reform does not materialize or is weak in the medium and long term. In terms of concrete policy application, countries seeking to increase domestic fuel prices should consider, when appropriate, mitigating measures and structural reform that focus on reducing energy inefficiency and enhance access to other sources of energy, including, we look at the electricity, but you also have LPG, you also have renewable energy sources. Access to credit is critical to enable firms to undertake the investment needed to switch to more efficient, energy-efficient technology. Where fiscal space allows, boosting infrastructure spending, including to support adequate and reliable access to electricity or alternative source of energy, would be beneficial to the productive sectors. However, the one limitation of our study, and we wanted to make it clear, is that the assessment of the impact of fuel increase on export should not be the only input to policymakers' decisions to undertake a fuel subsidy reform. They need to take a holistic approach. Look at what are the other macroeconomic impacts? What are the social implications? What are the political challenges that needs to be factored in before undertaking such a reform? And this has been widely extensively discussed in the book by Clement and others, and also an interesting paper by Inchos and Victor, where they focus on the political challenges to fuel subsidy reform. Thank you very much for your attentions. I'll stop sharing and see if there are any questions I would like to hear from you. I think there's questions on the chat. Maybe let me stop sharing, and I'm happy to go back to the slide later. Yes, I think John Mutua has a question. Rebecca, do you mind?
Sure, you do have a question. It is regarding energy dependency in developing countries. What happens if these countries are well endowed with renewable energy sources?
So, sorry, can you say again? Yes.
Regarding.
Oh, yeah, now I can see the question.
Okay.
Yes. Okay, regarding energy dependency, what happened to this country that? Yeah, that's a very, very good question. In fact, in the paper, we're trying to use two indicators, like the consumption of LPG, liquefied petroleum gas, per capita, and also the access to renewable, not access, but the amount, the share of renewable energy in total energy consumption. And we found that since we're looking at developing countries, these shares are really, really low. So we don't find a significant impact, and that could be attributed to the fact that in those countries, even if they are endowed or they have access to this resource, they have the capacity to produce these renewable resources. Access is very low. Like in sub-Saharan Africa, for example, you have there is a huge potential in solar energy, but still you have very few firms that rely on solar energy. They still use like, how to say, generator, because access to electricity is also constrained, and because they are faced to shortages, and they have to use the diesel fuel to generate electricity, which has even has a like a worse impact, damaging impact on the environment than the electricity produced by centrally by the company. So I just wanted to flag that we need to separate availability in the sense the country is endowed with energy source, renewable energy sources, but also the access. We need to separate the two. Unfortunately, we don't have good indicator to assess that in our paper. There was also questions on so the first question was from Yang Q Yang, and then John Mutter has a questions on access to credit post-COVID has been scarce. How can developing countries raise credit given the challenge they are currently facing? This is acute drought and other related. Yeah, this is a much broader question. The question of it's much broader issue. The question of access to credit, and it has to. There are a lot of factors that can help. First, better business environment, but also creditworthiness, like transparency in the accounting of those firms. Many of the firms they don't have good collaterals, or even the banking sector, because it's both from the uh, the demand side from the company themselves, because they don't have transparent accounting, and also from the supply side, from the banking system. The banking system, which it's maybe too much risk averse, right? And they tend to rely more on lending to the government because it's risk free. They buy government bond and they have 6-7% return on the government bond relative to lending like at 14, 15, 20% to the private sector, and take risk there, and risk to lose the uh, 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 um, to lose the investment or the loan, because also non-performing loans are high. All they require collateral that are multiple times the amount of the loan they are given. So much more broader issues, and of course the issue was much bigger even before the COVID-19 pandemic, and the COVID-19 pandemic has worsened this issue. Yeah. Thank you very much. And okay, so those are the two questions that I hope I addressed them. If there's any follow-up questions, I'm happy to handle them. Any other questions? Okay, so I thank you very much for your time, for your attentions. I don't know, I think my email should be online, but I can give it now in the chat. I'll give you my email address, and feel free to reach out if you have any additional questions on this. Let me type my email address. Sorry, I made a mistake in the email address.
You
Okay.
do have an additional question that has come in. It's,
Okay, we have additional questions. Excellent. Let me do. Yes, given the data is yes, given the data used in the studies for the year 2014, how can the study inform post-COVID and the war in Ukraine? This is an excellent question, which we got during the review process. I think in the oil prices are quite volatile. If you look at 2014, you'll see the same, you see similar cycle. Even the crisis in 2028, you have oil price reach $180 a barrel, then drop completely to drop significantly to less than 50 at the end of 2028, and then goes to, I don't know, close to 100 in 2024 before. So you have this volatility, which you are observing now. What you observe during COVID and the war in Ukraine, you can see the same pattern back then. But I agree with you that there is a need, and I leave this to future research, to update the data and see if there are any difference in the pattern, not in the pattern, but in the marginal impact on the export sector, especially with COVID and the disruption in supply chain, which add to the difficulty of this export-oriented firm. So this is a very interesting avenue for future research. Let me also emphasize that the fuel price data is not widely available. What we have done, with one of my co-authors, we have compiled domestic fuel prices for 180 countries in the world. And the latest version of the database we have published span from 2000 to 2020. So we are in the process to update the database to 2022 to capture the COVID-19 pandemic period, but also the war in Ukraine. So the data is available, and I would invite everyone, whoever is interested, to take up this challenge. So thank you very much. Okay, if no other questions, I would like to thank you again for your attention, the very interesting question you raised, and I'm available for discussions outside, and with my email, yeah. Thank you very much. I'll say back to you, Rebecca.
IAEE wishes to thank Roland Kpodar for an outstanding webinar. This webinar will be available on IAEE's website for future download. If you're not already a member of IAEE, we encourage you to join by visiting www.iaee.org. We thank you for attending, and I officially close this webinar.